There is a saying, no risk, no reward. Every investment or asset comes with a risk, and the level of risk varies depending on the type. With every investment you make on the stock market, there is a possibility of a stock bubble. A stock market bubble can be best described as a quick rise in the price of stocks over a short period, followed by a sudden or significant contraction in prices. So how do you invest during a stock market bubble without losing your hard-earned money? In this episode, we'll take a look at stages of a stock market bubble, historical stock market bubbles, how to spot a stock market bubble, plus one trivia question about a stock market bubble. Today's trivia question is, why was the first stock market crash in the US called Black Tuesday? What is a stock market bubble? A stock market bubble is a type of economic bubble taking place in stock markets when investors drive stock prices above their value in relation to some system of stock valuation. Typically, a bubble is created by a surge in asset prices that is driven by exuberant market behavior. During a bubble, stocks typically trade at a price or within a price range that greatly exceeds the asset's intrinsic value. The price does not align with the fundamentals of the asset. The stock market bubble includes three key phases: the catalyst that starts the bubble, the inflation of the bubble, and its deflation. 1. The start of a stock market bubble. A stock market bubble begins to occur when a large number of investors flock to a particular stock without taking into consideration the stock's intrinsic value. As the price of stocks rises, it attracts the interest of investors who want to quickly become rich and plan to sell these stocks to the next investor at an inflated price. However, when there are no more investors willing to pay the overinflated price, the bubble either bursts dramatically or deflates slowly. Investors make these decisions blindly, even when they have access to trading tools. 2. The bubble begins to inflate. In this phase, the market trends higher with large amounts of capital flood, as people with large sums of money get to know about the stocks and the potential it holds. Mutual funds, hedge funds, pension funds, and other institutional investors join in. Moreover, credit institutions become more willing to make riskier loans, as borrowers become more willing to take on debt. A small number of investors also prefer to sell off in this phase, as they want to cash in their first profits. During this phase, the media picks up the story. Eventually, demand for the asset exceeds its supply, leading to a spike in prices. 3. The bubble pops. Due to an event like a piece of news, a change in government policy, or a bankruptcy, the price gains stall. As pessimistic stories gain traction, there is a decline in investor confidence and more selling happens. Buyers who finance their purchases with borrowed money get distressed. Panic selling leads to a huge decline in the asset price. The bubble pops as prices crash and sometimes decline even below the pre-levels of the bubble. In some cases, the panic sets in immediately. However, sometimes it takes a few months for panic to set in. A lot of people lose money when the bubble bursts. If you're inquisitive to know what happens after a stock market bubble, make sure you hit that subscribe button and stay tuned for our episode covering that topic in detail. How to find a stock market bubble. Spotting a stock market bubble is almost impossible. However, having knowledge regarding the steps involved in bubble formation and studying about historical bubbles might help investors to avoid their participation. Let's take a look at some historical stock market bubbles. Historical stock market bubbles. The dot-com bubble, 1995 to 2001. Also known as tech bubble or internet bubble. The use and adoption of the internet grew to extreme levels during the late 1990s. Investors started throwing money at any internet-based company without considering whether the entity holds any potential. In 1999, the bubble reached its peak value, with dot-coms holding crazy level valuations. However, by 2001, internet companies lost nearly 2/3 of their value. The bursting of the bubble took down several startups, as either their proposed businesses proved to be unprofitable or investors cut off their funding. Though not all the companies were failures. Some of the entities like today's internet giants Amazon and Google survived the dot-com bubble. The real estate bubble. 2006 to 2012. Real estate has always been considered as one of the safest investments. However, this myth burst after the 2008 housing crisis. From 1940 onwards, the United States real estate sector enjoyed growth every single year, with real estate prices soaring high until 2008 when the housing bubble finally burst. In the early 2000s, mortgage interest rates were low, consequently consumers opted for large loans. Moreover, banks gave mortgages to even those who didn't qualify for a mortgage due to either low income or a low credit score, believing that they can get their money back as well as earn a profit by selling the property. Once the property bubble burst, several financial institutions across the globe were hit hard as people who were unable to repay their mortgages started to default. Some of the world's largest financial institutions and investment experienced major liquidity issues, owing to which the global economy almost collapsed. The cryptocurrency bubble, 2017 to 2018. Then comes the cryptocurrency or Bitcoin bubble. 2017 was the year of the cryptocurrency. Bitcoin began the year at $993 per Bitcoin and ended at over $13,000 per Bitcoin, a 1,200% gain. The ability to carry out anonymous transactions caught the attention of investors, leading to the bubble. The cannabis bubble, 2018 to 2019. With the Canadian government legalizing the use and sale of medical cannabis, investors saw an opportunity to invest in any company that wanted to enter this emerging space, leading to the cannabis bubble. The COVID-19 bubble, 2020. Lastly, COVID-19 took the world by surprise. Biotech companies are at the forefront working to produce vaccines that will protect people. As a result, investors are throwing money around with the hopes of cashing in when the stocks of these companies surge. So how do you spot a stock market bubble? Spotting a stock market bubble is easy if you can provide answers to these three questions. 1. Is something new happening? If something new is happening in a sector, there are chances that a bubble might occur. The real estate bubble occurred because interest rates and regulations were lowered to favor those that were not qualified for a mortgage. 2. Are investors speculating? One of the leading causes of a stock market bubble is investor speculation. Investors believe that the prices of stocks will climb. As such, they throw money around. A good way to know when investors are speculating is to follow up with stock-related news, Yahoo Finance, Twitter, and StockTwit. 3. Are sector prices climbing abnormally? If the prices of stocks are climbing abnormally, there is a possibility of a stock market bubble. How to make profitable investment decisions during market bubbles? You can still make money during a bubbling stock market. Your best bet is to look for two types of stocks: short and long-term stocks. Finding short-term stock. Here is how to look for a short-term stock during a bubble stock market. Invest in companies with a strong history. Invest in companies with an increase in demand during the bubble. Invest in companies that have been producing proprietary personal protective equipment for years. These companies tend to perform well during a stock market bubble. Finding long-term opportunities. The best way to invest during a stock market bubble is to look for the 4 quarterly earnings report of the companies you're interested in leading up to the time when the bubble began. For each report, take note of the following: total revenue earned, net earning after deducting expenses, how much debt the companies have incurred, has any new product or service been launched during the market bubble. After taking notes of the 4 quarterly earnings report, compare your findings with the performance of the companies before the market bubble. If the companies are still doing well, then go ahead with your investment, otherwise avoid them. Making the right investment decisions during a market bubble can be very lucrative. However, it's important to remember you're risking a loss anytime you invest. So, back to today's trivia question. Why was the first stock market crash in the US called Black Tuesday? It was called Black Tuesday because it's the date marked the beginning of the Great Depression, which lasted until the beginning of World War II. That's it for this episode. If you learned anything new today, smash the like button. And if you want to support us even more, buy us a coffee from the link in the description. If you'd like to improve your financial knowledge in the next 12 months, hit that subscribe button and turn on the notifications. Good luck and see you in the next episode.